Investing in stocks is one of the most popular ways to diversify your portfolio and build wealth over time. By gaining an understanding of how the stock market works, you can make well-informed decisions that are tailored towards meeting your specific financial goals. This video is intended not only to help beginners understand the fundamentals, but also answer any questions they may have about stock market terminology and concepts. Please note that we are not financial advisors. The information and reports provided here should not be construed as investment or financial advice. We do not endorse any particular investment or financial strategy and encourage viewers to seek the advice of a licensed financial advisor before making any investment decisions. Let's start with answering the question, how does the stock market work? The stock market is a financial market where investors buy shares of stock from publicly traded companies. When an investor buys stock in a company, they become a shareholder and are entitled to a share of the company's profits and assets. The stock market is made up of exchanges where stocks are bought and sold, like the New York Stock Exchange, NYSE, and the NASDAQ. Investors can use a broker, either online or at a traditional brokerage firm, to buy and sell stocks. The stock market is a key part of the world's financial system. It is also an important part of the economy because it gives companies a way to get money and gives investors a way to make money on their investments. The stock market can be a volatile place, and the prices of stocks can change a lot depending on many things, such as the economy, how well a company is doing, and market trends. Investing in the stock market can be a good way for people to grow their wealth over time, but it is important to know that there are risks involved and that it is not right for everyone. Before deciding whether to invest in the stock market, investors should carefully think about their investment goals, how comfortable they are with risk, and how much money they have. Why should you put your money in the stock market? Putting money into the stock market can have a number of benefits, such as 1. Potential for long-term growth. Historically, the stock market has given good returns over the long term, and stocks can gain value over time. 2. Diversification. If you buy a variety of stocks, you can spread your risk and maybe make it less likely that the bad performance of one stock will hurt your portfolio as a whole. 3. Professional management. Many stock mutual funds and exchange-traded funds, ETFs, are run by professional investment managers who do research and choose stocks for the fund. This can be helpful for investors who do not have the time or knowledge to research and choose individual stocks. 4. Income potential. Some stocks pay dividends, which are shares of a company's profits given to its shareholders. These dividends can be a way for investors to make money. 5. Liquidity. It is easy to buy and sell stocks, which makes it easy to get your money back if you need it. What are the bad things about putting money into the stock market? Investing in the stock market comes with its own risks and possible problems, such as 1. Volatility. The stock market can be volatile, and the value of your investments can change a lot over time. This can make you lose a lot of money, especially in the short term. 2. Risk of loss. There is no guarantee that your investment in the stock market will make you money. In fact, you might lose some or all of what you put in the first place. 3. Fees for professional management. Many stock mutual funds and exchange-traded funds, ETFs, are run by professional investment managers who charge fees for their services. These fees can cut into your profits and make you less money overall. 4. Market risk. The stock market is subject to many risks, such as economic downturns, geopolitical events, and changes in market conditions. Your investments may be worth less or more because of these risks. 5. Lack of control. As a shareholder, you do not have much say in how a company's management team runs things. You also cannot change the direction or performance of the company much. How do you start buying and selling stocks? People can start investing in the stock market by taking the following steps. 1. Decide what you want to get out of your investments. The first step in investing in the stock market is to decide what you want to get out of your investments. Are you trying to save money for retirement, grow your wealth over time, or find a way to make money. Knowing what you want to get out of your investments will help you figure out what kinds of investments are best for you. 2. Figure out how much risk you are willing to take. Before you start investing in the stock market, you should figure out how much risk you are willing to take. Stocks can be risky, and over time, the value of your investments can change by a lot. If you do not like the idea that you could lose money in the short term, you might want to think about investing in bonds or cash instead. 3. Choose a brokerage account. You'll need to open a brokerage account before you can start investing in the stock market. There are several brokerage firms that offer online trading platforms, and you can choose the one that best fits your needs. 4. Put money into your account. After you have opened a brokerage account, you will need to put money or securities into it. You can do this by putting money into the account from a bank account or another source, or by moving securities from another account. 5. Do research and pick your investments. Once you have money in your account, you can start doing research and picking your investments. There are many kinds of stocks, bonds, mutual funds, and other investment products to choose from. When making your choices, it is important to think carefully about your investment goals and how much risk you are willing to take. 6. Keep an eye on your investments. Once you have made investments, it is important to keep an eye on how they are doing and make changes as needed. This could mean rebalancing your portfolio, selling investments that are not doing well, and buying new ones. It is important to remember that investing in the stock market comes with risks, and you cannot be sure that your investments will make you money. Before you decide whether to invest in the stock market, you should carefully think about your investment goals, how comfortable you are with risk, and your current financial situation. So far, we have covered how the stock market works, why you should or should not invest in the stock market, but also how to get started if you think it is right for you. Now we are going to cover common terminology you will often hear when investing in the stock market that every investor should know. What is a blue chip stock? Shares of businesses that are seen as being successful and financially solid are referred to as blue chip stocks in this context. These businesses often have a lengthy history of delivering dividends to their shareholders and have established themselves as leaders in their respective industries. Blue chips, which are typically the most valuable in the game of poker, are where the phrase blue chip originates. A blue chip stock has a high market capitalization, consistent earnings growth, excellent balance sheets, and a record of dividend payments. These businesses also frequently have strong management groups with a track record of overcoming obstacles like economic downturns. The greater stability of blue chip stocks in comparison to other kinds of assets is one of the key advantages of investing in them. Compared to smaller or less established businesses, these corporations are less likely to encounter substantial price changes since they are financially stable and have a proven track record of performance. The potential for long-term growth of blue-chip stocks is another benefit of investing in them. Although the gains from these companies might not be as rapid as those from other high-risk investments, they can nonetheless deliver steady returns over time through dividends and share price growth. Investors looking for income-producing assets may find it advantageous to invest in blue-chip stocks. Regular dividend payments from many blue-chip firms to their shareholders can be a dependable source of income for retirees or other investors looking for passive income streams. It is crucial to remember that buying blue-chip stocks does not come completely risk-free. Even the most financially secure businesses might suffer reductions as a result of shifting market dynamics or unforeseen occurrences like natural disasters or regulatory changes. However, not all investors may be able to access these equities because they are typically more expensive than similar stocks on the market. Blue-chip stocks can, however, be acquired indirectly through mutual funds or exchange-traded funds, ETFs, that specialize in these kinds of securities. What is a dividend? Dividends are a method used by businesses to disperse a percentage of their profits to shareholders in the world of investment. Dividends are simply recurring payments paid by businesses to their shareholders, usually once a quarter or once a year. These compensations may come in the form of money, shares, or other assets. Dividends have always been a significant component of the stock market and are a major factor in luring investors to particular stocks. What are earnings per share, EPS? Investors use earnings per share, EPS, as a key statistic to assess a company's profitability and potential for expansion. EPS is determined by dividing a company's net income by the total number of outstanding shares. Basic and diluted EPS are the two fundamental varieties. Basic EPS simply considers the number of shares that are now outstanding, whereas diluted EPS also takes into account potential future share issuance via convertible securities like options or warrants. Depending on a company's performance and any one-time occurrences like asset sales or write-offs, its earnings per share, EPS, might change considerably from quarter to quarter. Due to this, a lot of investors like examining a company's trailing 12-month TTM EPS, which accounts for its earnings over the previous 4 quarters. Investors also take note of EPS variations between businesses operating in the same sector. A higher EPS in comparison to rivals may signify more effectiveness and profitability, giving investors assurance in their choice of investment. EPS is a valuable indicator for appraising firms, but investors should keep in mind that there are many other factors to consider when considering an investment opportunity. What is an initial public offering, IPO? Initial public offering, or IPO, is the process through which a private corporation offers its stock for the first time to the general public. This enables the business to raise money by offering outside investors ownership stakes in the company. An investment bank or group of banks are often hired by a company to underwrite the IPO when it decides to go public. A prospectus, which is a comprehensive document that offers information on the company's finances, activities, and other pertinent aspects, is created by the underwriters in collaboration with the company to identify the right price range for the shares. The underwriters start selling the shares to prospective investors once the prospectus is finished and approved by regulators. This process, called book building, entails enlisting the support of both institutional investors, such as pension funds and mutual funds, as well as ordinary investors. Potential investors indicate how many shares they are interested in purchasing at various price points during book building. The underwriters decide on an initial offering price for the shares based on this feedback. Trading starts on a stock market like the NASDAQ or NYSE on the day of the IPO. Typically, the underwriters buy all of the company's shares at the offering price and then sell them to investors at market rates. Early trading can result in severe price volatility for shares as supply and demand reach equilibrium. Let's discuss the fundamental concept in investing: market capitalization, also known as market cap. Market cap represents the total value of a company's outstanding shares of stock. It is calculated by multiplying the current market price per share by the total number of shares outstanding. Market cap serves as a crucial indicator for investors, as it provides information about the size and overall worth of a company. Generally, companies with larger market caps are seen as more established and stable, while those with smaller market caps are often viewed as having more growth potential. It's important to note that market capitalization alone does not provide a complete picture of a company's financial health or growth prospects. To make informed investment decisions, investors should consider other factors such as revenue growth, profit margins, debt levels, and regulatory concerns. Now, let's dive into the price-to-earnings ratio, a widely used financial indicator. The P/E ratio measures the valuation of a company's stock by comparing its market price per share to its earnings per share, EPS. To calculate the P/E ratio, we divide the current market price per share by the EPS. For example, if a company's share price is $50 and its EPS is $2, the P/E ratio would be 25, $50 divided by $2. A high P/E ratio can indicate that investors have high expectations for a company's future growth, while a low P/E ratio may suggest a more cautious or skeptical view. However, it's crucial to consider other factors alongside the PE ratio, such as industry comparisons and a company's growth prospects. Moving on, let's talk about stock splits. A stock split is a corporate action that increases the number of outstanding shares while proportionally decreasing the price per share. Companies use stock splits to make their shares more accessible to individual investors and enhance market liquidity. By lowering the price per share, companies aim to attract more buyers who may have been discouraged by higher prices. It's important to understand that a stock split does not fundamentally change a company's financial situation or growth prospects. The total market value of the shares and the company's overall profitability remain the same. Stock splits can be performed in various ratios, such as 2-for-1 or 3-for-1, where each existing share is split into 2 or 3 new shares, respectively. Additionally, there are reverse splits where the number of outstanding shares is reduced, often used by companies with declining stock prices. Before considering the impact of a stock split, investors should conduct thorough research on the underlying company, including its financial health, performance, and growth potential. Volatility is a measure of how much a stock's price fluctuates over time. It is often used as a risk indicator in the stock market and can refer to both upward and downward price movements. Volatility is quantified using statistical techniques such as standard deviation or beta. Standard deviation measures how far a stock's price deviates from its average price, while beta compares a stock's volatility to the overall market. High volatility may indicate increasing market risk or uncertainty, while low volatility may suggest a more stable market environment. Let's now discuss the 52-week high-low indicator. This indicator tracks the highest and lowest prices at which a stock has traded during the previous year. The 52-week high-low provides valuable insights into a stock's historical price range and can assist investors in understanding its performance relative to other companies in the same industry or sector. If a stock is trading close to its 52-week high, it may indicate investor confidence and positive expectations for the company's future. On the other hand, a price closer to the 52-week low could signal concerns or doubts about the company's financial stability or growth potential. However, it's important to remember that reaching a 52-week high or low doesn't guarantee future performance. That wraps up our comprehensive exploration of important concepts in the stock market. We covered how the stock market works and why or why not to invest in it. We also covered if you did feel investing in the stock market was right for you, how you could get started. Lastly, we covered definitions of common terms used when investing in the stock market, such as bull market, bear market, blue chip stock, dividend, earnings per share, initial public offering or IPO, market capitalization, price-to-earnings ratio, stock splits, volatility, and the 52-week high-low. Remember, investing in stocks involves risks, and it's essential to conduct thorough research, consider multiple factors, and develop a well-rounded investment strategy. Stay tuned for more educational content on investing and the stock market. If you found this video helpful, don't forget to give it a thumbs up and subscribe to our channel for more informative videos.